Greetings, everyone. In this session, we will dive into the risks and benefits of leveraged securities as a viable asset in your investment portfolio. Our team comprises of Chris Saliba, Darshan Shah, Jingyi Lee, and Arvind Prasad.
Today we will discuss leveraged ETFs for the retail investor. We will start off by describing the different alternatives to achieve leverage. We will zoom into the leveraged ETF products and why they are attractive for the retail investor. We will talk about the risks and how to mitigate them. And finally, sum up with our conclusions. Why leverage in the first place? The answer is straightforward. It's to achieve higher target returns. The right way to go about leverage, following modern portfolio theory, is to try to move up along the tangent line to the mean variance efficient portfolio, which is assumed to be a broad market index, the S&P 500 in our case.
Here are some of the ways to get leverage for retail investors. The pros and cons and how to get access to leverage from these products is explained herewith. Out of the below, derivatives, hedge funds, and leverage ETFs are the most complex because they require high level of sophistication and knowledge before investing in them. Investor activeness is also highest for derivatives, followed by leverage ETFs because they are publicly traded and volatility can lead to huge swings in value and can also lead to losses. How do leverage ETFs work? Leverage ETFs use financial derivatives and margin borrowings or cash to gain the desired exposure of 2x or 3x of the underlying to amplify returns for the investors. Objective is to seek daily returns equal to 2x or 3x of the underlying before fees and expenses. Beyond one day, the exposure and direction may deviate from the stated multiple because of compounding effects, use of derivatives, and volatility decay. Volatility decay is the phenomenon that causes profit or loss due to directional change in the underlying. A seesawing market can result in losses due to compounding effects of leverage. As we see here, the losses are on account of compounding effects of leverage. When the value of underlying goes up, leverage ETFs increase exposure to the index to match 2x of the underlying exposure, and when value goes down, they have to sell, which leads to losses of already fallen securities. How do they get leverage? They make use of a combination of actual securities in the underlying index, equity swaps, and index futures. As seen here, SSO gets roughly 90% of its exposure from securities underlying the index, roughly 1x from equity swaps, and remaining 7% from equity index futures. They also keep some cash, which can be used as margin or also to meet redemption requests and derivative losses. These exposures are good for one day and have to be adjusted, rebalanced on a daily basis, which may require the fund to buy and sell securities, attracting capital gains and losses. How do they use equity swaps? SSO and UPRO enter into equity swaps to receive return on S&P and pay variable rates such as SOFR plus spread. If at the end of day one, S&P goes up by 2%, then the fund receives 2% and pays SOFR plus spread for one day. However, if S&P goes down by 2%, then the fund pays 2% on S&P and also the variable rate, which is a double whammy effect. There is no exchange of principal at initiation, and generally there is no requirement for collateral.
A retail investor can create a portfolio of the underlying market index and leveraged ETFs to achieve any leverage ratio desired. The investor can select from multiple leveraged ETFs. To exemplify, using SSO, which is a 2 times leveraged ETF of the S&P 500, an investor can allocate 90% of their portfolio weight in SPY, 10% in SSO to achieve a portfolio leverage of 110%. The leverage ratio of a portfolio built with SSO or UPRO will evolve over time and will not remain constant. On this chart, we show a hypothetical example of a portfolio of 150% leverage ratio, built either using SSO or UPRO. And as this graph shows, we can see that the leverage ratio evolves from 150% up to 176% for SSO and 243% for UPRO. This implies the need for rebalancing. Rebalancing allows the investor to maintain the desired leverage ratio target and can actually yield better risk-adjusted returns. On the charts here, we show the evolution of the cumulative portfolio value over time from 2009 to 2023. On the left-hand side, we show the case without rebalancing, and on the right-hand side, we show the case with rebalancing. It's important to note that on the right-hand side, even though the cumulative value at the end of the period is less, the Sharpe ratio is actually better. On the slide before, we showed how theoretical daily rebalancing works. However, a retail investor with a tolerance of 1% change in their leverage ratio will need to rebalance much less frequently. For SSO, the most dynamic rebalancing requirement is every 5 months, while for UPRO, it is at every 2 months. The retail investor is generally required to balance 2 to 10 times more frequently using UPRO versus SSO. So UPRO should only be used when desired leverage ratio is above 200%. In order to study the historical performance of SSO and UPRO, we compare performance against simulated benchmarks at 2 times SPY for SSO and 3 times SPY for UPRO. The key findings are that both SSO and UPRO outperformed the benchmarks on cumulative and risk-adjusted returns over the period of 2009 to 2023. However, given that the underlying return mechanisms of leveraged ETFs are path and time dependent, it is no surprise that their performance varies based on the selected period. They tend to outperform simulated benchmarks during upturns and underperform them during downturns.
We compare two strategies, A, investing $10,000 into SSO, and B, investing $10,000 into SPY and borrowing another $10,000 on margin to reinvest in SPY. Monte Carlo simulation was used with a range of margin interest rates between 4 to 12%. As observed, returns are significantly impacted by margin expenses, which accumulate over time, seen on the adjacent image, showing about $13,000 in margin costs. The bottom line, the SPY on margin strategy yielded a CAGR of 7.7%, underperforming the SSO investment, which produced a CAGR of 10.86%. Once more, Monte Carlo simulation is employed to forecast the final value of a $10,000 initial investment over 3 time horizons, 5, 10, and 15 years. Historical mean and standard deviation were used to make predictions. The adjacent figure indicates that holding SSO for longer duration results in a higher investment value. When pitted against a margin-invested SPY strategy or a hypothetical twice-leveraged SPY, SSO outperforms substantially.
What are the risks associated with leveraged ETF? First is regulator and compliance risk. It may be limited by trading strategy or regulator guidelines, and change in value may impact various financial statement reporting and compliance ratio, so investors should seek approvals and guidance from various stakeholders, and scenario analysis on impact on key compliance and reporting ratio should be conducted and monitored. Second risk is swap counterparty risk and drawdown risk. Counterparty may be default on swap transactions. Investor needs to ensure that issuer select trustworthy counterparties and retail investor to understand the drawdown risk. Third is volatile returns. Monthly rolling costs may incur when the swap are settled, and so return has high standard deviations. So rebalancing with volatility timing strategy, hedging strategy, stop loss order cover put strategies can be utilized to mitigate the risk.
When it comes to retail investors, a critical factor to consider is whether any regulatory constraints exist regarding leveraged ETFs and associated legal battles. In a sense, no such restrictions currently exist. In Canada, the responsibility rests with the ETF issuer, while the CSA and IIROC provide guidelines for brokers selling these products to investors. Similarly, the SEC in the US is responsible for issuing such guidelines and has implemented Rule 18F-4 prohibiting any new funds with 3 times exposure. High-risk leveraged securities such as SSO require careful consideration, especially when attempting to minimize drawdowns. By utilizing a neural network algorithm that incorporates 5 economic variables, one can reasonably predict the most significant drawdowns. Historical data from 2006 has demonstrated this, with a table on the right indicating that the warning signs were visible both before and during the 2008 financial crisis. By acting on these signals, investors can avoid significant drawdowns such as the 37% drop that occurred in October 2008.
How can we manage wild and exotic shortfalls? First is to buy insurance put. It is a right to sell the securities by a set date at a set price to cover potential losses. However, the coverage period is limited and the premium paid may increase when implied volatility level goes up. Second strategy is volatility timing portfolio rebalancing strategy. The weighting of the security in the portfolio is adjusted dynamically based on the volatility level. However, the weight and the concentration risk may increase significantly when the vol level is low. Third strategy is dynamic hedging strategy. The potential losses will be hedged when the vol level increase. It has the ability to maintain static weight of the hedged securities. However, additional capital needed to purchase the inverse ETF and may incur borrowing costs.
Rebalancing with volatility timing leads to improved returns while maintaining or even improving the Sharpe ratio. The accompanying graph highlights how a two-asset portfolio featuring SSO and SPY performs with and without rebalancing. Significantly better returns are observed when a volatility-timed rebalancing approach is used, with an increased allocation to SSO. Though a 10 or 20% weight would be reasonable, an investor with a lower risk aversion can adjust the weighting with a 48% weight for SSO, leading to markedly increased returns and a better Sharpe ratio.
Does dynamic hedging works? We look at a scenario where dynamically adjust the portfolio weight based on the real-time testing of SSO VAR level. When the estimated one-day VAR level of SSO is exceeded, 10% of the inverse ETF SDS will be automatically loaded to hash the portfolio for that day to mitigate the potential downside risk of the portfolio for that date. And the annualized Sharpe ratio of the dynamic hedging portfolio is 6.53, which is higher than the annualized Sharpe ratio of the static portfolios of 0.54.
So in conclusion, leveraged ETFs offer an easy way for retail investor to obtain leverage on the market index while remaining relatively passive. Its key selling points are the low equivalent cost of credit and the no credit score requirement, as well as the relative ease of access, administration, and management. Leveraged ETFs work by trying to achieve a multiple, usually 2 times or 3 times return of the underlying index's daily returns. They invest in equity securities, swaps, and futures. Their return mechanics are quite complicated and are path and time dependent. Overall, they perform well, beating a theoretical 2 times or 3 times index during periods of upturns, but can also underperform during periods of downturns. They are also expected to perform well in the future. Leveraged ETFs are much easier to handle than margin accounts and are expected to yield better results over the long term, although with the additional risks of underlying swaps and futures that are not easily observable in the typical standard deviation risk measure. There are multiple ways to hedge risks such as insurance puts, volatility timing, and dynamic rebalancing. Some of these strategies are more involved for a passive investor, but they do yield better performance.
Thank you everyone for watching, and we look forward to receiving your questions.